So when we start looking at what is happening in refined products and what's happening with U.S. demand, we want to look at, again, the key drivers, for which for us remain gasoline, jet fuel, distillate, resid, because these are the key ones that, again, go into that mobility piece. And here you can see when you look at 2021, you had that nice little spike, then you had that fail, that drop down, and that was Memorial Day. That was where you normally get that spike and then that fall down. Here you can see that we're just not getting that same level. Instead, things are kind of flatlining here, and we expect to see that flatlining continue, because if you look at 2019, you had the spike, that little kind of calm down that we've talked about, and then another that step up. We're just not going to get that, and that's all driven based on people looking at what's the price at the pump, and that hesitancy to continue to spend that. But you still have to go to the store, you still have to go to work, you still have those things that are happening, but you still have that hybrid. We went on over the weekend, we went to a barbecue, and it was interesting to hear how, what is your work schedule? And a lot of people are Tuesday to Thursday in the office, Monday, Friday home, and then as you go into the weekend, the summer, they're giving you an extra day where you can essentially be home for 3 days, at the office for 2 days. So we're and it's continuously. I mean, that we're seeing that in all of the data. We showed it again on the Econ show. Is that the hybrid schedule is really getting fixed into this market right now. And that's really shaving some of that. And obviously, who wants to be in the office when in the summer? So I don't think anyone's going to complain when we look at some of those key pieces going forward. So and then diesel is again remaining depressed. We will get a little bit of a step up, but it's going to be fairly muted as we go into the rest of this summer. Now, when we look at distillate stocks, even though the demand side is still where it is, we're still getting those small draws. Another 530,000 barrels were drawn out of the system, 29.5 million below the 5-year average. But again, it's pad one. Pad one is 22.4 million below the 5-year average at 590,000 barrel a day, the 590,000 barrel drawdown, with again pad two being there, but pad three is 600,000 barrels a day above the 5-year average. It's that disconnect as to where is this product, and pad one continues to be short. One of the things that we've been talking about is an additional amount of distillate coming into the Atlantic Basin and really competing between Northwest Europe and the U.S. Gulf, the pad one. And that's where we continue to see that come through. A decent amount of new Asian capacity from India, as well as from the Middle East. When we talk about Kuwait, Saudi Arabia bringing assets on, that again is going to move that flow into these areas, and it's going to keep imports elevated. Pad one had an increase of 179,000 barrels a day, 65,000 above the 5-year average. And then overall, the distillate side, the U.S. had an increase of 184,000 barrels a day of imports, 73,000 above the 5-year average. And again, that's going to remain elevated, a large part of that being driven by pad one. And here, when you look at the storage side, we should have been seeing an increase and a fairly steady increase of storage, and we're just not getting it. We're just going a little mostly sideways, which is great for crack spreads. But when you start looking at the demand metrics, the supply metrics, it becomes concerning, because we need to build ahead of winter burn for heating oil. So again, this is going to be a key one to watch as we go forward. And here, just to put it into perspective, where pad one sits, we're at a record low, and we had another drop. And you can see here, we should have already had that strong pivot, and those builds, we're just not getting them. And that's where that differential, that spread is going to incentivize more product coming into the Atlantic Basin, and then having their pick of, do I go to New York Harbor or do I go to Northwest Europe? And that's where we're going to continue to see product coming into this market, while pad three continues to build. So how do you get that line two? So Colonial line 2 is mostly distillate heating oil. So that's tapped out. So how do you get that going through? And it's Jones Act vessels, but after Jones Act vessels, there's no other option. So again, you have that kind of beholden piece that they're going to continue to try to push that higher. Now, when you look at distillate products supplied, we're just below the 5-year average. As we were saying, we expect to be, right either below or right at the 5-year average, because we do have more than normal trucking demand, but well off of the highs that we saw in 2021. And that's going to be a perpetual kind of commentary as to where we are, which is going to keep us a bit muted. As you can see here, we're just sitting here right around the same level that we saw previously, at about 119, but we do expect to see this drop. The question is going to be, when does that drop come through? Because when you look at the underlying demand for where things are, you typically get a little bit of that drop to about 105. So we went from 119 down to 105. That's usually for what we have coming into the Memorial Day weekend, and then we'll start to see that creep higher, but really stay just at about that 120 level, just given that we do have demand, we do have inventory that has to be replenished, but you still have the supply chain issues that remain from when does this Chinese product actually show up. Now, one of the things that we were talking about is that because there's not the same dire need there has been, we expected to see a little bit more going on to rail, which is what we saw on the intermodal side. So there was a nice step up in intermodal units. We're still 2.2% below the 2021 week on week, year on year. But again, we're still seeing some of that increase. Grains had a dip. Metallic ores and metals had a dip, but again, motor vehicles remained strong. Now, we did have a decent drop in sales, but there's such a backlog right now that they're still going to see some pretty steady activity as they try to fill that backlog at this point. Again, keeping, right now, total carloads are just 4% below 2021 levels. And it's again, just going to continue to edge up. And we expect to actually take out 2021 levels, because there isn't the same impetus to get things instantly. There is a little bit more inventory. You're going to try to save on just labor and diesel, and you're going to see a bit more going onto the rail system. So here you can see that we've had a little bit of an increase in carloads. So here we're seeing some of the different pieces as we're seeing import volumes coming through. It's just the problem right now is the percent change at this point. So when you look at the movement in general, we're seeing some of this coming in. The change from the previous week remains week on week, year on year, starting to creep back up in June, but the middle of June, but it's still going to be fairly soft just because of what happened in China, because a lot of that comes into this specific port. And I should say the West Coast in general. As that gets passed through, we will see these pick back up at a higher clip as we head into July. Now, when you look at the heating side and the cooling side, obviously the cooling side because we're in summer, things are going to be either fairly normal or slightly below in the north, pretty much from the Pacific Northwest over to the Northeast. But when you look at essentially from California over to Virginia, West Virginia, you're going to be above normal. So there is a decent heat wave coming through in the south. That's going to accelerate the natural gas burn, and you should see that pull down a little bit more propane. But again, you're seeing this is going to be a positive for where natural gas is right now. Well, as things pull into the into that cooling period. Gasoline stocks had a draw of 710,000 barrels. That's 19 million below the 5-year average. But when you look at it, obviously, Pad 1 is 14.8 million below the 5-year average. So again, it's more of a Pad 1 situation where that Pad 1 had a drop of 730,000, while Pad 3 had a build of 2.83 million. Now, Pad 3 is 2.2 million barrels of gasoline above the 5-year average. So it's that disconnect of how do we go from Pad 3 into Pad 1. That's going to continue to move things through. As we've been talking about, there is a large amount of gasoline coming from Europe into the U.S. It has not started to show up, but even without it, we did get an increase in imports of 48,000 barrels a day into Pad 1, which if you look at it throughout the whole U.S., we had an increase of 43,000 barrels a day, which takes us we're 75,000 barrels a day above the 5-year average, and that's going to continue to go up. And we will cross over 1 million barrels a day of imports And that's why we've started to see that flatlining in the demand and that drawdown on storage, because we're going to continue to see that shift as those imports come through and demand continues to be fairly soft. Now, even with demand soft, there's still a sizable spread on reasons why you would come into the U.S. markets. Now, when you look at what the refiners are doing, production of gasoline increased 1.23%. So we're almost to a 62% yield on the gasoline front, where distillate had a drop of 56 basis points. So there's about 31% distillate cut, 62% gasoline cut. We expect them to go a bit heavier on the disty side versus this time last year. But gasoline, obviously, even though we are seeing slowing demand, we're still in driving season. We're still in this period. So you still will see some of that movement. But a lot of it is going to come off of the floating market, just because there is a record amount in Europe. There's a record amount in Singapore. And we'll talk about that in segment 3. So when you look at gasoline total inventories, you can see that we've gotten that flat line, something similar that happened in 2015. We do expect that to flatline and start to come back up, even though you normally see a fairly steady decline. We just expect this to flatline and come up a bit as the comps get a bit easier as we head into the end of driving season. And that's where we expect to see some of these unseasonal builds at this point, driven based on imports and the slow amount of demand. So China has had a nice little spike as things have gotten a bit back to normal. Again, people were locked in their homes, so now they're going to go out. They're going to try to get things that they needed, may have run out of, and we do expect that to come back down to that 100 mark or closer to normal, as we've had dips in both Americas, Europe, and then on the world stage as Asia Pacific flatlines a bit. And we've seen more cuts. So India cut taxes on petrol, petrol prices, just to try to take away some of that inflation pressure. That's going to provide some of that support here. But as we've been saying, as we get to the end of June, it's going to be very expensive to maintain a lot of these different spreads and a lot of these different subsidies, which as they fade away, that's going to eat into the demand side. And then when you look at Asia Pacific and North America based on TomTom, again, things continue to be a bit soft, which we think, again, continues through. A lot of that being driven based on this chart. When we look at gasoline prices, sitting there at $4 and just over $4.71, you can see that we've broken back out. We kind of flatlined. Things are continuing to move up, and then we even have diesel picking its head back up and heading back closer towards $5.60. Again, people see this up front. It's a shock to the system when you see it, especially when you do a normal fill up that maybe cost you $40 is now costing you something closer to $80. There is a big kind of eye-popping response. And again, this is something that is impacting just how quickly and how much people are willing to drive and spend. So blending components, again, something similar, have flatlined. When you look at blending components in general, there was a small drop of 140,000 barrels. That's just 3.9 million below the 5-year average. When you take out 2020, you can see that we're much closer to the 5-year average. So there's really not too much to say in terms of where we are. We see this going flat, increasing just a bit, but again, staying fairly stable at these levels. And the reason why is because of this chart that we've talked about. When we look at gasoline demand, we're still at the very low end of this, and we should have seen a sizable bump. We expect this to be fairly flat going forward, but we should get one step up and then kind of flatline at an elevated level, something closer to about 9.4 million barrels a day of demand. And instead, we're sitting at about 8.9, and we don't see that changing all that much. We'll obviously have July 4th. We'll have some bigger weekends, but we're just not getting the same step change that we normally get. When you look at the average, you can see that we normally get that average way up, especially even factoring in 2020. and we're still tracking fairly low. And a mixture of that is because of that workplace side. We're still 20%. Obviously, this is having Memorial Day in it, but we're still 20% below normal on the workplace, and it's unlikely to close that gap, especially as we go into summer, keeping some of that. And then obviously between work and the fact that people just are going to look at that and be like, I'm not going away right now. Or I'm not driving that far to go away. It's more of a staycation or something closer to save on some of that fuel cost. Propane, propylene, moving, the rate of change is fairly steady. We don't expect that to change. We had a build of 3.24 million. That's just 1 million below the 5-year average. And we just expect it to follow this same rate of change that we had the last 3 years. Not just the last 3 years, more thinking about 2021, 2017, and 2018. Days of supply for propane following those years as well. We don't see that changing all that much, just because a lot of the excess that comes through will be going into the export market. Jet fuel had a build of 500,000 barrels. That's just 1.4 million below the 5-year average. Here you can see we had that spike that we normally get this time of year. And then you can see that it had it in 2019. Depending on when it is, we had it in 2018. And we do expect that drop to go just below that right around that 1.5 million barrels a day of demand. And here's why. Typically, you can see in 2019 where Memorial Day fell. You had that nice spike up, but you can see that we never got that spike in 2022. And I don't know if you've looked at airline tickets recently, but my God, are they expensive. And that's where I think you're seeing some of this flatlining demand, where we're just not getting those higher highs. We're staying fairly flat. And typically, as in the next 2 weeks, with most kids ending school between, let's say, June 14th and June 20th, you can see you get that step up, and then it holds fairly firm from, let's just call it the last week of June till about the second week of August. And then you start to see things slow down as people start school back up, depending on where you live. Some people start mid-August, some end of August, some beginning of September. But that's where you get that decline. We're just going to see this follow straight through. And that means that the comps are going to get a bit worse versus where they are historically. And that's where, when you look at 12-week ahead passenger departure schedule, things remain fairly set, just 0.4% lower week on week. Again, nothing crazy as we go through into that period. And then open table regions, when we look at restaurants, you can see that right now we're about 5 to 10% better on the weekdays, and about, at this point, 15 to 20% better on weekends. And a lot of that is being driven by Australia. And again, when you start looking at where the U.S. is, you can see that we're still fairly in line with what we were talking about as things, balance. Yeah, people are still going out. It's just not going out as much as I think people were hoping for. And a lot of that is just due to inflation, cost, a lot of these pieces that are weighing on people's ability or desire to go spend that money. So that's what we have for you on the U.S. front, especially on the demand side. We expect it to remain a bit soft, but now in the next segment, we're going to go bigger into OPEC, what's happening there, and what do we see for the global refined product market.